You're watching Silver News Daily. Subscribe for more.
It's really, you know what the craziest part of it is to me, Dunnigan, is that if you would have told me that, gold was at 3,000 bucks, let me look at the futures here real quick. And silver over 34. Let me just see what the futures are here real quick. Of course, my computer never cooperates when I'm asking it to. So the futures on silver are up to 34.63. And the futures on gold are at 3,039. If you would have told me that that'd be the case and there's virtually no mainstream media attention, I would have said there's just no way that that can be the case. I mean, my entire career, gold at 3,000, people would have said you're crazy. I remember when Jim Sinclair said gold would hit 1650, and he was called, he was looked at as being, crazy. There's no way gold could be 1650. This is when it was 400 and 500. So to see it at over 3,000, to close it over 3,000, to breach that level, and really not to see any acknowledgement of it is really shocking, especially with what's going on in London and New York.
Silver is standing on the edge of a historic eruption, and almost no one is ready for it. Andy Schectman's prediction of $45 silver by April isn't just a bold claim, it's a warning shot. Gold has already shattered records, soaring past $3,000, but silver? It's still sitting in the shadows, waiting for its moment. And that moment could be just weeks away. For years, the LBMA and COMEX have controlled silver's price with a mountain of paper contracts, promises of silver that don't actually exist. But what happens when the world demands real metal, not IOUs? What happens when investors wake up to the fact that paper silver isn't backed by enough physical supply? The answer is simple: a market earthquake. Central banks, billionaires, and entire nations are scrambling to secure hard assets, draining vaults of physical gold and silver at a record pace. Meanwhile, industrial demand is surging, with silver's critical role in technology, energy, and defense making it more indispensable than ever. Yet supply is dwindling, mines are struggling, and then cracks in the system are growing wider by the day. If history has taught us anything, it's that silver doesn't move in slow, steady steps. It moves in violent surges. In 1980 and 2011, silver exploded seemingly overnight, shocking the markets and leaving unprepared investors behind. And this time, the forces at play are even bigger. So is $45 silver just the beginning? Or are we about to witness something far more dramatic? Stay with me, because by the end of this, you'll see exactly why April could be the most important moment for silver in decades.
Forward contracts, you can't purchase futures contracts from New York on the LBMA. And so it's drying up the liquidity in London, where they would use, a lot of the banks would hedge their positions in London with forward contracts, derivatives, paper. Remember, in London right now, there's 200 and roughly, last week, I don't know, it's probably a little less now, but 279 million ounces of gold in London. Only 36 of that is available for delivery. The rest belongs to ETFs in the Bank of England. And that's standing behind 380 million ounces in outstanding spot contracts, 11 times nearly the number of contracts issued versus the amount of gold issued. And in silver, it's very similar. Roughly 270 million ounces of silver is all that's available of the 800 million. Now it's under 800 million, like 770, 780, because we saw 85 to 90 million ounces. That's what COMEX is on track for, to be delivered for March, of silver come into COMEX, almost all of it coming from the LBMA. And so and when you talk about 290 million ounces and there's available, yet they're trading 2.9 billion ounces of silver, again, 10 times the number of contracts standing behind or the metal standing behind those contracts, 10 times the number of contracts. To me, what it really speaks of is the lack of trust in the LBMA system, that no one trusts that they'll be able to deliver anymore. And they're trying to tell us that it's a logistics thing. It's a lack of trucks and a lack of manpower. I think they're realizing that the exchanges are being bled dry. And maybe now what we see is COMEX trying to distance themselves.
Gold has already made its move, breaking past $3,000 and grabbing global attention. But silver? Silver is still the sleeping giant, waiting for its moment. And history tells us that when silver finally wakes up, it moves with a force that leaves everyone stunned. Look back at every major gold rally and you'll see the same pattern. Silver lags behind at first, seemingly ignored, only to explode past expectations when the market finally catches on. In 1980, gold surged and silver followed with a 900% gain in just months. In 2011, gold hit record highs and silver rocketed from under $9 to nearly $50. The same setup is forming right now, but this time something is different. Gold isn't just rising, it's being hoarded by central banks at the fastest pace in history. Nations are moving away from the dollar, stockpiling gold as a hedge against economic turmoil. The last time we saw this kind of accumulation, silver wasn't just an afterthought. It became the go-to asset for those who couldn't afford gold. And here's the key. Silver isn't just an investment metal. It's also an industrial powerhouse. As gold makes headlines, silver's demand is quietly accelerating in the background, driven by a surge in technology, energy, and manufacturing. This isn't just another cycle. This is the foundation of a historic silver supercycle, one that could see prices rise to levels we've never witnessed before. So, if gold's breakout is already happening, what does that mean for silver? And why is the timing of this surge more critical than ever? Stay with me, because what's happening behind the scenes at the LBMA and COMEX could be the final trigger that sends silver into overdrive.
That's not a good thing. So, yeah, and a lot of the banks who would hedge their positions would do so with unallocated contracts in London. So, you take these massive short positions and then try to hedge it with unallocated positions in London. That's not a good thing. It's going to, in my mind, start to really emphasize physical markets versus futures markets. And that's something that none of us would thought would have ever happened. Now, I guess we'll find out. But it's not just the United States. I mean, we've seen in India in January and February, 44 million ounces of silver delivered to India on top of all the silver they've been buying over the last 4 years. So, we're seeing China buy massive amounts of gold as well. And that's been well documented. China has purchased, what have they purchased? Let's see, I think I have that number. Central banks have purchased almost 1,200 tons in 2024 alone. So I don't have the exact numbers that China has purchased, but it's an awful lot. And look, the bottom line is that physical demand, de-dollarization, alternative exchanges, these things are all happening in real time and all at the expense of the LBMA. And it appears as though, I mean, if you take a step back and you look at it, they throw out the idea of tariffs, which really don't seem what it is to me, and which allowed for all of these exchanges for physical with fungible COMEX contracts into London, and the metal was flowing. And then I think they're starting to realize that this is deeper. So then they come out and say, well, it's not a T+1 anymore, it's T+8 weeks. This is a big deal. And it's a big deal because the banks that have been suppressing the price forever may just have lost the ability to do so easily anymore, because they're not going to be able to offset these positions in London with massive unallocated positions when you have all these entities standing for delivery. People's Bank of China has added 600 tons of gold in 2024 that we know of, probably a whole lot more, not to mention what they purchased. But this heavily unallocated paper gold to physical ratio market is breaking. And when you realize HSBC, Scotiabank, JP Morgan, they depend on these derivatives and these unallocated gold to hedge their positions. They're not going to be able to take these massive naked positions anymore, these positions that have allowed them unabated to manipulate the market, because as I've surmised for a long time, there are entities starting with the BRICS and now the United States that are getting wise, I think, to just how important physical is in a game that's rigged. When you see Jeffrey Gundlach come out, the bond king, saying, $4,000 gold is easy and in the cards, you're beginning to see a lot of big name people understand exactly what's happening. And $3,000 gold, if we see these trends continue, will be a distant memory. And I don't really talk that way, but it just seems as though these are the kind of things that could certainly push gold a whole hell of a lot higher.
For decades, the LBMA and COMEX have been the gatekeepers of the silver market, controlling prices through an ocean of paper contracts. But that system is now under pressure like never before. The cracks are showing, and when they finally give way, the silver market as we know it could collapse overnight. Here's the truth. There's far more silver being traded on paper than actually exists in physical form. The LBMA and COMEX operate on a fractional reserve system, where banks and institutions issue contracts representing silver they don't have, keeping prices artificially low. This has worked for years, but now a tidal wave of physical demand is threatening to expose the illusion. Just look at the numbers. Silver vault holdings are draining at an unprecedented pace. Investors and industrial buyers alike are demanding delivery, forcing these institutions to scramble for actual metal. And with silver production struggling to keep up with demand, it's only a matter of time before a major default occurs. If the LBMA or COMEX fails to deliver, confidence in the entire paper-silver system could shatter instantly. And when that happens, we won't see silver creeping higher in slow, steady increments. We'll see a violent repricing as the market rushes to correct years of suppression. So how close are we to this tipping point? And what happens when investors realize that holding paper silver could mean holding nothing at all? The rush for physical metal is already underway, and once it reaches critical mass, there will be no turning back.
Not as bad as it was. In gold, it was up to 84 bucks an ounce at one point. Silver, certainly, it was bigger. But, if you look like, for example, right now in China, as an example, when you talk about arbitrage, silver today was at last night was at $35 an ounce in spot in Shanghai. So there is arbitrage around the globe, but not as significant as it was a few weeks ago. Because it's becoming too difficult to get it there. So I think that arbitrage, which would necessitate some form of expediency in getting the metal sent this way, when you're talking 8 weeks delay, not really worth the effort. But now that these contracts are being stopped, I think that this is something that is going to start to perhaps put great strain on the physical market, perhaps could put a run on the LBMA and really start to shift price setting and global awareness to other exchanges, in particular, Shanghai, Dubai, Moscow. We've talked about this. Now, is this the beginning of that? Well, it sure looks like it could be. But the United States is now prioritizing delivery over paper, which is something wholly, completely different. Almost all the gold that has come over the 25 million ounces or so, almost all of it has already been delivered. So if this delivery continues, you'll see strains on COMEX as well. All I can tell you is that whatever is happening in London, it's the beginning of the possibility of an existential event for some of these banks that are massively short if they get copious amounts of delivery requests, 10 times the amount, 11 times the amount of paper versus gold. That's a situation I certainly wouldn't want to be involved in if I was a board member of one of these commercial banks.
The race for physical silver is already underway, and it's accelerating at a speed that Wall Street never saw coming. Across the globe, investors, industrial giants, and even central banks are scrambling to secure real metal, not paper promises. The supply squeeze isn't coming. It's already here. Look at what's happening in major vaults. Registered silver inventories on COMEX have plummeted, with stockpiles being drained at an alarming rate. The LBMA is in the same position, seeing its physical reserves disappear as more buyers demand actual delivery. And unlike previous cycles, this isn't just a short-term trend, it's a structural shift in the market. But here's the problem. There simply isn't enough silver to go around. Decades of price suppression have discouraged new mining projects, leaving global silver production stagnant. Meanwhile, demand is exploding, with industrial use at record highs and investment demand surging. The result? The premiums on physical silver are soaring, and the disconnect between the paper price and real-world availability is widening fast. For those still holding paper silver, this should be a wake-up call. If the system fails to meet physical demand, contracts could become worthless overnight. And once that realization spreads, the rush to secure real silver will go from a steady climb to a full-blown panic. So, what happens next? The answer lies in one of the most overlooked signals in the market: The gold to silver ratio. This historic indicator is flashing a massive buy signal for silver, and when it corrects, the price surge could be unlike anything we've seen before.
Everything has come down. The ask price on pre-65 silver is as low as I've ever seen it in reality. And so, during the pandemic, the premium on pre-65 silver was off the charts. It was higher than everything but Silver Eagles. Um, Part of me believes that there will be an awakening by the public. I mean, the fact that we haven't seen it yet is astounding to me. The fact that we've gone to such a culture of greed where 30-40% rise in gold is not sexy enough, where at 9.9% per year for 25 years is not sexy enough. The fact that the central banks have been buying it hand over fist is not sexy enough. The fact that we are now a net importer is not sexy enough. And it's not Bitcoin, it's not Nvidia, it's not Apple, it's not risk on, but quietly the tortoise seems to be pulling out ahead in the race. And yeah, there'll be an awakening at some point, and you'll see premiums on things like junk silver go straight to the moon again, simply because it can't be reproduced. But when you start to see things like we're seeing, where exchanges are being bled dry of their 1,000-ounce bars, and central banks are being told 8-week delivery delay, and 145% of the London float delivered in the last 3 months. These things are getting real, and I've never seen anything even remotely close to this. And it's hard trying to take this information and discern what is really happening. And I don't profess to really know, but simply to take all of the pieces and put them together and say, yeah, this could actually be what they are doing. And I've been talking about this now for a few weeks, and it keeps happening. More and more things are happening that would say, geez, that's supporting that argument quite nicely. So, Dunnigan, yes, I think that silver, certainly, look, we're right at 35, almost there. We're just a little bit below 35 on the futures. You get above 35, there's virtually nothing there to stop it between it and 45, and then the sky's the limit. Now, is that going to happen? Well, every time, when Rick Rule comes on, and I've said it a million times too, we haven't been really right yet, but it was in the past, and that is gold really leads the way, silver languishes, but then on a percentage basis, slingshots. Well, silver has been acting quite nicely the last few days. Could it bust through this resistance level? You see how much silver is being exported out of London and imported into India and the United States and China and now Russia. We talked about China buying all the doré and the concentrate. They're the second largest producer.
The gold to silver ratio is flashing a warning that few are paying attention to, but those who understand history know exactly what's coming. Right now, the ratio is hovering at extreme levels, meaning silver is historically undervalued compared to gold. And every time this ratio corrects, silver doesn't just rise, it explodes. Let's break it down. The gold to silver ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged between 40.1 and 50.1, but today it's hovering near 80.1, an anomaly that has only occurred during times of extreme market distortions. And here's the key. Every time the ratio has reached these levels, silver has responded with massive gains. Look at 1980. The ratio dropped from 80.1 to 16.1 as silver skyrocketed nearly 900%. The same thing happened in 2011. Gold moved first, and then silver shot from under $9 to nearly $50, bringing the ratio back down. Now, with gold pushing record highs above 3,000, silver is once again lagging behind. But history tells us that this won't last for long. What makes this time different is that the forces driving the correction are bigger than ever before. We're not just dealing with speculative of demand. Silver is facing an unprecedented industrial supply squeeze, and central banks are shifting their strategy. Once the ratio starts to collapse, silver will enter a phase of rapid repricing, and those who wait on the sidelines could be left watching as prices surge past all expectations. So, what's fueling this coming breakout beyond just investor demand? The answer lies in silver's critical role in the industries of the future, and why an unstoppable supply crunch is already underway.
Somewhat nefarious. It was always HSBC Bank. I believe HSBC Bank only holds about 2 million ounces of the entire stock of GLD. yeah, I mean, you could see the price of GLD go much higher just following the price of gold, but that's not the way to own it. It just isn't. And when people have asked me, do you think gold will be confiscated? I've said it forever. I think they'll take the ETF. So if we are indeed trying to reshore all of this gold, and you put, in essence, the agent of the US government, that being JP Morgan, in charge of the largest stockpile of silver in the world and one of the largest of gold, and none of us can take possession. It just seems like it would be easy if they make this switch, instead of confiscating physical gold, activating eminent domain to disclose those funds and give it to the US government. Held by, JP Morgan's holding more gold in their two vaults, one in London, one in New York, than the majority of the G20 countries. So to me, I get nervous when I think about GLD and SLV as a tool to siphon a lot of that gold and to confiscate it and add it to the stockpiles. And if they really are trying to revalue gold, I did a little exercise the other night. I took the total US money supply and took 40% of it. And the reason it's 40 is that, look, the United States was on a 40% gold back. It used to be 100%. And then somewhere in the 50s, they passed a law that made it 40% until 71. When Switzerland had gold backing, it was 40%. When the BRICS just proposed their new unit settlement token, it's 40%. Jim Rickards was talking 40%. So I took the money supply, 40% of it, the total money supply, and divided the amount of gold into it that we supposedly hold that hasn't been audited since 53. And it came out to over $12,000 an ounce. Now, could that happen? Yeah, why not? I mean, you're still talking 20%, nearly a little under of what Bitcoin got to. So why not have gold at 12,000, which would give the Treasury general account 3 trillion free and clear? They would just issue new gold certificates to the Federal Reserve, which, by the way, Federal Reserve does not have claim on any of that gold. There's confusion. People think that they do. They don't. The certificates that the Treasury more or less sells to the Federal Reserve or gives to the Federal Reserve as collateral for the money that goes into the Treasury general account is more or less guarantee on fiat currency. It's not the actual gold, which does belong to the Treasury. But if they revalue it to $12,000, giving it in essence a 40% gold backing, in line with where you would probably have to put it to do what Judy Shelton wants to do with backing the Treasuries, collaring them and redeeming them in 50 years for gold, the first thing you would do is reshore it quietly so as to not let everyone know what you're doing.
Silver isn't just a precious metal, it's an industrial necessity, and demand is accelerating at a rate the market simply isn't prepared for. While investors focus on silver's monetary role, a much bigger force is at play. An industrial supply squeeze, unlike anything we've seen before. Let's talk numbers. The solar industry alone accounts for nearly 20% of global silver demand, and that number is only climbing. Governments around the world are pushing aggressive renewable energy mandates, with billions pouring into solar infrastructure. The problem? There's no viable substitute for silver in high-efficiency photovoltaic cells. As demand for solar energy skyrockets, so does the need for silver, but supply isn't keeping up. And it's not just solar. The electric vehicle revolution is ramping up, with each EV requiring up to 50 grams of silver for batteries, wiring, and electronic components. The rapid expansion of 5G networks, semiconductor manufacturing, and medical technology is only adding to the strain. Every year, more silver is being consumed by industry, and yet mining output has remained stagnant, with production struggling to keep pace. The result? A growing supply deficit that's becoming impossible to ignore. In fact, the Silver Institute reported that in recent years, industrial demand has outstripped supply by hundreds of millions of ounces, creating a structural shortage that won't be easily resolved. For decades, silver has been treated as a cheap commodity, but that illusion is breaking. With the world now dependent on silver for technological advancement, the coming shortage isn't just a financial story. It's an economic reality that could push prices far beyond anything we've seen before. And yet there's another major force driving silver higher, one that's been quietly reshaping the global financial system. Central banks are shifting away from the US dollar, and their next move could send silver into uncharted territory.
Maybe I'm behind the times. Look, people give me a hard time for not posting my prices, but maybe this is one of the reasons I don't. I'm able to do these things. And Um, it- to me, there are some rare dates, 1996 Silver Eagle as an example, but most of the backdate coins should be less, in my opinion. And I will always sell them that way unless it's a truly special rare date. But this is, if SD, one of the biggest, best companies in America, is at 57, was I stupid to sell them at, a $4.79 or whatever premium? I don't know. I felt good about giving the guy a good deal. So it should not be most of the case, in my opinion, but maybe I'm missing something. Maybe I'm just not the best businessman in that respect, maximizing how much I can make. I mean, I don't know how else to answer it. That's as honest as I can be.
Central banks are making moves that could change the financial system forever, and silver is positioned to be one of the biggest beneficiaries. For years, the global economy has revolved around the US dollar, but now, nations around the world are working to reduce their dependence on it. The result? A shift toward hard assets, gold, and soon silver. We've already seen record-breaking gold purchases by central banks, with countries like China, Russia, and India stockpiling reserves at a historic pace. This isn't just a hedge against inflation. It's a calculated move to protect against the growing instability of fiat currencies. The trend is clear. Confidence in the dollar is fading, and central banks are seeking real, tangible assets to back their financial systems. But here's where it gets interesting. Silver is poised to follow gold's lead. Historically, silver has always lagged behind gold in these cycles, only to surge once investors realize it offers the same protection against currency devaluation at a fraction of the price. If central banks begin accumulating silver the way they have with gold, the already strained supply could be overwhelmed almost overnight. And let's not forget the role of inflation. As governments continue printing money and debt spirals out of control, the need for hard assets has never been greater. Investors who once relied on bonds and fiat savings are now turning to precious metals, accelerating a trend that could push silver into a breakout. So, with gold leading the charge, the LBMA and COMEX under pressure, and physical silver disappearing from vaults, why is April the moment everything could converge? The answer lies in key upcoming economic events, policy shifts, and market triggers that could light the fuse for silver's next explosive move.
I can see what the differences be too. I do know that theirs is typically lower than everyone's, and maybe it's because it's delayed. I will tell you that of all, right now, if you go to All Metals Quotes on their page, the ask price is 3,033.80. And let me look on my website real quick. Ours is 3,038. So, but if you look at every other one, ours is lower than all of them. Every one, we're lower than JM, we're lower than Atmex, we're lower than Money Metals, we're lower than SD. These are all fine companies. And you're right, that each company does have to come up with their own kind of the special sauce. It's the switch between the active futures contract and it should be just a little bit. I don't know why Kitco's is always lower than everybody's. They are. And maybe it's a delayed quote. I'm not sure. But if you compare ours to every other one out there that I just mentioned, let's look, for example. So right now, Miles Franklin is, not that it really matters, we're at 3,038. So we'll look at some very reputable companies. SD Bullion, very reputable. They're at 3,042.90. We look at JM Bullion, very reputable. They're at 3,047.48. We look at Apmex, very reputable. They're at 3,051.30. We look at Money Metals, very, very reputable. They are at 3,044.70. I mean, you keep going on. Ours will be lower than everyone's except Kitco. And I don't know why they do that. The only thing is maybe they're delayed 10 minutes or so, not quite sure, but against all the other major retailers, you could argue, and I'm not saying it's not true, maybe they're padding that price and making a few dollars on every ounce they sell. Is it theoretically possible? Sure. Could it just be that the way that they use or they hedge and do things, it's different? Sure. So not exactly sure, but spot price is should always be within just a few dollars. A few of these companies, it's a little high. I'm surprised. Amex is a little high, but compared to everyone else, but they're one of the biggest companies in North America, so they're doing something right. I don't mean to hide from the question. It's just that there is no definitive answer when you're trying to get a current spot price and taking the time delay off of the most active futures month. Um, it's a little bit of special sauce, so to speak. But I'm happy where we are. Certainly, of all the majors, we're either well, other than Kitco, we're the lowest. So that's definitely something that I'm proud of. You know,
Another
we're
thing
not
that
making more than we should. I'll put it to you that way.
April is shaping up to be the turning point for silver, a month where multiple forces collide to create the perfect setup for a breakout. This isn't just about speculation. It's about undeniable market mechanics, economic shifts, and financial events that could trigger silver's long-awaited surge. First, we have key Federal Reserve meetings. The Fed's stance on interest rates has been one of the most significant drivers of precious metals in recent years. If policymakers hint at rate cuts or show further weakness in the dollar, it could send gold soaring, and silver, historically, reacts with even greater intensity. Then there's the growing global uncertainty. Geopolitical tensions are rising, trade policies are shifting, and nations are making moves to reduce their exposure to Western financial systems. Every time uncertainty increases, demand for hard assets spikes, and silver, both an industrial necessity and a monetary safe haven, stands to benefit. On top of this, COMEX silver contracts are set to expire in April, and if a flood of investors demand physical delivery instead of cash settlement, we could see serious pressure on the already depleted silver inventories. If COMEX struggles to meet delivery demands, it would be a flashing red signal that paper silver markets are on the verge of breaking. And let's not forget inflation data releases. If inflation remains persistent or accelerates, investors will rush toward tangible stores of value. Gold has already responded to inflation fears, but silver, still undervalued by historic standards, has yet to catch up. That catch-up could happen in a matter of weeks. The stage is set. Central banks are shifting, supply is shrinking, and investor sentiment is turning. But silver's market is unlike any other. It's small, highly reactive, and prone to extreme volatility. When silver moves, it moves fast. And understanding the psychology of the silver market could be the key to staying ahead of the coming surge.
That's true. That's a fair point. In her book, she does talk about issuing shorter duration treasuries as well. Um, I guess it's a fair question. Why not just buy the real thing? I would suppose it has something to do with just that, U.S. treasuries are tier one, and gold is tier one. So, maybe it's easier to do it that way. If all of a sudden gold becomes very difficult to obtain in those large quantities, maybe it's easier to buy U.S. treasuries, which are probably more fungible, easier traded. She also did say that her desire was to see stable coins issued off of the treasury bonds as well, which again would facilitate the treasury market, just like they're doing right now through Tether and USDC and the stable coin issued through what's it called, XRP or Ripple Labs. So they're all backed by U.S. Treasuries. So it's a fair question. I would assume it has something to do with the tier one status and regulated status for like insurance companies or for pension funds or those kinds of things. So maybe they put a lower coupon on it, not a 0%, but maybe a diminished coupon. And she does talk about issuing shorter duration as well. So I'm sure there's something behind it. I'm not an expert in the treasury market, but it is a fair point. I would rather own the real thing than a treasury tied to it, but I'm sure that's not always an option for some of these entities.
The silver market isn't like stocks, bonds, or even gold. It's smaller, more volatile, and driven by a unique mix of investor psychology and market forces. And when it moves fast. Understanding this is the key to grasping why silver could go from an overlooked asset to the most in-demand metal almost overnight. History has shown us that silver's price surges are often fueled by sudden waves of panic buying. Unlike gold, which is primarily held by central banks and long-term investors, silver's market is dominated by retail buyers and traders looking for outsized gains. This creates a cycle of extreme volatility. When confidence builds, silver spikes hard and fast. And then there's the supply factor. Unlike gold, which is largely hoarded, silver gets consumed. The amount of silver available for investment is a fraction of what's in circulation. This means when demand suddenly rises, there isn't enough metal to meet it, forcing prices higher. In 2011, silver went from under $20 to nearly $50 in less than a year. Why? Because once momentum kicked in, investors piled in, forcing the price into a near parabolic rise. The same thing happened in 1980 when silver skyrocketed almost 900% in months. Each time, it wasn't just fundamentals driving the price, it was the psychology of a market waking up to silver's true value. Right now, we're seeing the early signs of that same shift. Silver is still lagging gold, but as more investors realize the opportunity, the rush could begin. And with LBMA and COMEX already struggling to meet demand, a silver squeeze could develop at any moment. But here's where it gets even more interesting. The last time silver ran toward 50, market manipulation and sudden intervention stopped it in its tracks. This time, with paper, silver markets under pressure and physical silver disappearing, what happens if the usual suppression tactics no longer work?
To me at all. And more often than not, there are some backdates that are worth a little bit more. But I just sold a client just the other day. He bought 10,000 ounces of Silver Eagles, backdates, which were less money than the current dates. And they were all sealed boxes. 5 of the boxes were 2021 San Francisco mint. You go look, I sold them at the backdate price. You go look at what anyone is selling 2021 San Francisco mint coins for. And if you're listening, sir, you know who you are. I told him, I said, most companies will be selling these for a lot more. In fact, let's just look at one company and see S Mint Silver Eagles. Let's see what it looks like, if anyone has any. So I mean, the 2021's on, and there, it doesn't say San Francisco, it just says type 1, which these were. Let me just look at one more and see if someone has the 2021 San Francisco Mint Silver Eagle. So it is a way. Here we go. Let me just see what it says real quick. So they have them for San Francisco. Oh, they don't have any. Oh, here we go. 2021 San Francisco Mint SD is at 28,561. That's $57 a coin.
Right. Silver has always been the most heavily manipulated metal in the financial system, with institutions using paper contracts to suppress its true price. But this time, the system is under more strain than ever before. The question isn't if silver will break free, it's when. And when it does, the consequences could be explosive. For decades, banks and financial institutions have shorted silver, creating an illusion of abundance by flooding the market with contracts that have no real metal behind them. This has allowed them to keep prices artificially low, preventing silver from moving in line with its true supply and demand fundamentals. But now, cracks are forming in the system. The LBMA and COMEX are seeing physical inventories vanish as investors demand real silver instead of paper claims. Major dealers are reporting delivery delays and rising premiums, signs that available silver is running out. If enough investors call for physical delivery at once, the institutions that control the silver market could face a crisis they can't contain, and this time there may be no bailout. In 1980, the Hunt brothers tried to corner the silver market, sending prices soaring. The government stepped in, changing margin requirements overnight and forcing silver into a brutal crash. In 2011, when silver surged toward 50, sudden margin hikes triggered a massive sell-off, slamming prices back down. But now, the situation is different. Central banks are hoarding gold, investors are waking up to silver's value, and supply is vanishing. If a short squeeze happens today, it won't just be speculators driving the price, it will be the realization that silver is genuinely scarce. And if COMEX or LBMA fails to deliver, trust in paper silver could collapse entirely. At that point, silver won't just be reacting to investor demand. It will be repricing itself in real time, free from decades of artificial suppression. But where does that leave those who are still holding paper silver? Could they be left with nothing while physical silver skyrockets?
Not to be said for owning the American-made coins. The flexibility is second to none. And if knock that off, and if we see premiums even approach half of what they were during the pandemic, and I can't see why we wouldn't. I mean, this to me tells me we're on the heels of something very big in gold and silver. Really do. And um, if stuff is disappearing at the highest level, how fast before that trickles down into this level? I mean, after all, the coins come from the big bars. The big bars come off of the COMEX typically. You know, the U.S. Mint will take delivery of contracts and send them to Sunshine Mint for refining into planchets, and then they send them to the U.S. Mint for stamping. So, um, could that translate into much higher premiums on everything across the board? Yeah. And if things get to where they were, or anywhere even close to it during the pandemic, awareness wise, yeah, I think it is the time to do it, because nothing corrected downward from its previous peak the way that junk silver did. 11, 12, 13, $14 over the price of silver nationwide for 2-3 years. And now it's under $2 over spot. I mean, it is a steal. I would argue that if people had a lot of silver bars, those are really the only things that trigger dealer reporting anymore on sellback. So if you do more than 1,000 ounces at a time, so over time you could do that. You could trade 5, 6, 7, 8, 900 ounces at a time. Doesn't mean you're not supposed to do the reporting. It just means that we are not required to do dealer reporting. Junk silver used to be on that list of reporting in excess of 1,000 face when you sell it, $1,000 face value. But they got rid of that because it cannot be used to settle a COMEX contract. It's just bars. So to me, if you own bars and you want to get something far more flexible, do it over time. If you do it all at once over 1,000 ounces, you will need to provide a social. But you could do several transactions over a period of time. You don't want to call us up and say, I got 50 bars and I'm not going to file. You could just say, hey, I got 7 bars. I'd like to switch to junk. Or maybe if you do 8 bars, which is 800 ounces, you can get a full bag, 1,000 face. Be real close to that, I would bet. Real close to it. And you do that a few times, you pare down your bars, you move into junk silver, which has better upside potential, which is way more flexible. And there's no dealer reporting. Some people don't like that dealer reporting. Doesn't mean you're not supposed to let uncle know when you sell anything and make a profit. But just to cite the law says anytime you trade more than 1,000 in bars, we need your social. So to me, bars are even better than rounds because the rounds have that utility. The bars, that's the one knock against them, is they lack the utility, especially as silver goes higher.
For years, investors have been told that holding paper silver, ETFs, futures contracts, and other derivatives is just as good as owning the real thing. But when the system breaks, those holding paper silver could be in for a devastating reality check. The problem is simple. There's far more paper silver in circulation than actual physical silver. The COMEX and LBMA operate on a fractional reserve system, meaning they issue contracts for silver they don't physically have, betting that most investors will never demand delivery. This has worked for decades, until now. With vaults being drained and premiums on physical silver soaring, the risk of a major delivery failure is higher than ever. If just a small percentage of paper silver holders demand real metal at once, the system could freeze, leaving investors with nothing more than empty promises. We've already seen hints of this happening. In recent years, major silver ETFs have struggled to secure physical silver to back their shares. Delivery times have been extended and shortages are becoming more common. And if the LBMA or COMEX defaults, the consequences will be catastrophic, not just for silver investors, but for the entire financial system. When trust in paper silver collapses, demand for physical silver will explode overnight. The price gap between paper and real silver will widen, and those holding physical metal will be in control. At that point, the only question left is, how high can silver go when it's finally allowed to trade at its true market value? The answer lies in one key factor: price resistance levels. Once silver breaks through critical thresholds, the floodgates could open, and the next phase of this historic rally will begin.
But not as much to me. I mean, um, GLD and SLV are held by JP Morgan. And, JP Morgan, who paid a $920 million fine for manipulating the market and still allowed to run SLV at the time, the largest silver trust, their desk made $1 billion that year and they paid a $920 million fine. So they make 80 million, get slapped on the wrist, and still control these ETFs, now controlling GLD. To me, it's much easier to take the metal held in GLD and SLV, the delineation being that, well, you can't take possession of GLD and SLV. You can take possession out of the depositories. If you wanted to really take a stretch, I guess you could say the IRAs would be easier to take than just physical metal held at Brinks. But even still, you're allowed to distribute that metal. It would send the wrong signal. It just seems it would be so much easier and cleaner and not breaking any laws or violating civil liberties to take GLD and SLV. You can't take it anyway. So desperate governments do desperate things. I get it. You can't prepare for every eventuality, but I would be much more concerned owning an asset that tracks the price that you can't ever take possession of versus owning the real thing in a depository, which in essence is a contract between you and the entity. So could they do it? Sure. It's lower on my concern list by a long shot, though.
Silver's price has been suppressed for decades, but every market has a breaking point. And when silver finally smashes through its critical resistance levels, we could see a breakout that stuns the financial world. The first key level to watch? $30 per ounce. This psychological barrier has acted as a ceiling for years, with silver repeatedly failing to hold above it. But once that level is breached, the next resistance point, 35s, comes into play. Historically, silver moves violently once it clears major resistance, and a clean break past $35 could trigger a rush of momentum buying. Beyond that, $50 per ounce is the ultimate test. This was silver's all-time high in both 1980 and 2011. Each time, the price was artificially suppressed through intervention, first by margin hikes, then by massive short-selling pressure. But if silver breaks through $50 this time, there's no telling how high it could go. Some analysts believe silver could finally push toward its inflation-adjusted peak of $150 per ounce or beyond. What makes this moment different from past silver bull markets? The structural shortages. The paper suppression schemes are weakening, industrial demand is at record highs, and physical inventories are vanishing. If silver breaks through resistance and investors realize there's not enough supply to meet demand, we won't just see a gradual rise, we'll see a historic repricing. At that point, the silver market will be unrecognizable. The decades-long manipulation could finally unravel, and those who position themselves early will be the ones who benefit the most. So, where does this leave us? If Andy Schectman is right and silver hits $45 in April, is that just the beginning? The final step brings everything together and reveals why this moment in silver's history could be unlike anything we've ever seen before.
Not now, no. I will tell you there was a period of time, which I can't even believe, we did the numismatic swap recently, which was such a good deal. I mean, we sold 11,000 ounces pretty quick. I'm happy that both of our clients were able to take advantage of that. But I do know that some dealers were actually melting $20 gold pieces down during that period of time, like halfway through last year, up through the first quarter, the beginnings of the first quarter this year, during the Trump euphoria, during the Nvidia risk on Bitcoin trade, where people were selling gold, and then the dealers had to come up with tens of millions of dollars to buy the 2025 allocation. So we've talked about that, where at the beginning of the year, we have to spend, tens of millions of dollars to buy all the new 2025's gold, silver, and platinum for Canada, Australia, Austria, South Africa, US, and UK in all different sizes. And that costs a tremendous amount of money. So they were melting those down and to come up with credit, sell at refiners, because they were just sitting there, which is crazy, and It's really interesting the way the retail market has a lag behind the big traders up on top. I'm very, very confident that we will see things dry up very quickly. Um, it goes, that's how it always goes. And when you see such a huge drive to accumulate COMEX bars and LBMA bars and now 8-week delivery delays and all sorts of rumors and innuendo, it's just a matter of time before that finds its way down into the retail space, and a market that I still think for the music stops will be defined by inability to readily source cheap product. But no, I don't think they're doing that quite yet. I mean, I guess you could say it's not a horrible idea because, you know, there was a point a few months ago where our cost was a little bit below spot, and then sell it to the public for next to nothing. But that was kind of indicative of it, not having any demand at all. So it's not entirely possible. We haven't done it, I'll tell you that much.
Silver isn't just on the verge of a price breakout, it's on the edge of a financial paradigm shift. Andy Schectman's prediction of $40 silver in April isn't just about one price target. It's about the larger forces converging to expose the truth about silver's real value. The collapse of the paper silver market, the depletion of physical inventories, and the growing demand from both industrial and monetary sectors are creating a situation where price suppression simply can't hold any longer. Gold's surge past $3,000 was the first warning sign. Now silver is preparing to follow, just as it always has, but with even greater intensity. When silver moves, it moves fast. And the moment investors realize that holding paper silver may leave them with nothing, while physical silver skyrockets, the scramble for real metal will accelerate beyond control. The LBMA and COMEX are already running on fumes, and if their systems fail, silver's revaluation will be instantaneous. Could $45 silver in April be the first domino to fall? If history repeats itself, and if the gold-silver ratio collapses as expected, this might just be the beginning of an even bigger move. If silver finally breaks free from decades of manipulation, we could be looking at triple-digit silver prices for the first time in history. The financial world is changing, and those who see the shift before it happens will be the ones who benefit most. The only question left is, will you be ready? So you need to make sure to stay ahead of the game, subscribe for more updates, and let us know in the comments where you think silver is headed next. And remember, this isn't financial advice. Always do your own research and consult a professional before making any investment decisions.